Welcome back, and we have with us Mr. Rinkesh Roy, Joint Managing Director and CEO at JSW Infra, joining us this morning. Very good having you here, Mr. Roy. Let me first start off with the kind of bullish guidance you've given. The goal is to get to an EBITDA of 5,000 crore by FY28. Two questions here. One is what will drive that growth? And second is how much of this business will come from the JSW Group? I understand that JSW Steel does have a large contribution to the business even now. And how much from outside? Give us a sense of that.
Okay. So, good morning to you. And number one, your question was about how are we going to reach that 5,000 EBITDA mark. It's a combination of two factors. One is on capacity addition that we are doing. Currently, we are at 183 million tons capacity, and we are upping it to 300 by this current financial year, by the end of this year. So this 300, that additional 117, they will be having their ramp-ups in 28 and 28. So that is what is going to drive the EBITDA. The second part of it is the logistics business. So currently, this year, we did close to 143 crores of EBITDA. This we are targeting to reach 400 in this year and 700 in FY28 by a combination of ramping up the rake fleets and also, adding terminals into our portfolio. So that would be the two main drivers for growth. The third part of your question was about the synergy between group cargo and third-party cargo. So currently, as we speak, we are at a 50-50 distribution, 50 group and 50 third-party. As and when these projects get commissioned, depending on what kind of projects, some are tailor-made for the group, some are terminals which like the one which we won in Kolkata. These are mostly third party. So depending on that, the needle will be swinging between 45 to 55%. And our sweet spot is 50-50. So that is where we will try to get the needle back in whatever form.
Good to hear that, Rinkesh. And where would the volume settle? You guided for a 10% volume growth, but you closed the year flat?
We actually would be guiding this year at around 127 to 128 million tons. And this would be on the, we are seeing the first quarter coming up quite nicely, and there's a lot of demand in the Indian ports. So that's what is going to drive the growth, plus the interim operations that we start in different ports. The existing terminals that we have in Paradeep are looking good, brighter than what we saw last year. So these would be driving, the volume growth this year.
I want to talk about Fujairah also because, Rinkesh, that is a big concern and talking point in the market because you had provisioned about 68 crore rupees despite insurance covering the loss of profit. Is there a risk that the claim doesn't come through fully, and could the Middle East situation force a rethink on your overseas strategy then?
So currently we are operating actually in two terminals in Fujairah and Dibba port, where we are mostly on an O&M basis. That's, a fee kind of a contract basis. The terminal that was affected was the oil storage terminal. And mind you, this was for every terminal in that region, everyone was affected. It's not us alone. And we had, a series of meetings with the government also. We're quite upbeat about the future of that terminal because these ports lie outside the Straits of Hormuz. They are not inside Hormuz. And the UAE government is betting big on Fujairah, Dibba and Kharfukan, along with the Oman ports that you have. So on a longer basis, these ports will really come up strong in the future, and the government is also actively promoting them, putting in more pipelines, rail networks, the works. So we are very upbeat on this thing that albeit we had a short-term problem, and we expect at least 50% of our capacity to be up and running soon, as and when the things normalize.
Mr. Roy, just trying to get a sense, how is EXIM playing out overall, given everything that's playing out in West Asia? Is there any kind of an impact that you're seeing? From what I'm hearing from you, there's not much of an impact. What explains that? Because clearly...
So it's the nature of, our ports and our terminals and the cargo that we handle. If you really look at our Indian port operation, we are heavily, into energy movements and steel, raw material for steel plant movement. Our exposure to containers is very small at Mangalore, especially. We have a container terminal. And the way things are panning out, the way the shift is taking place towards more domestic electricity production, and with a strong base on thermal, especially coal. So we are seeing these upticks coming in at Paradip Coal Terminal, where you have coal getting exported from Mahanadi coal fields to the southern states. And you would have read in the newspapers also, there's a record demand for electricity in India. So I think these are the facts of the matter, and we are seeing a good surge in traffic in the first quarter.
There's one more thing that I wanted to talk about. Your net debt, which is now doubled. You're spending about almost 16,500 crore rupees over 2 years. How high are you willing to let leverage go?
No, we have given a guidance that at no point, and you see, we are investing close to 30,000 crores in the ports and 9,000 in the logistics business. And at any point of time, we have given a guidance that we will not cross 2.5 debt to EBITDA ratio. So that is the guidance we have given. And we are pretty sure that as and when the capacities come into play and ramp up, these numbers will come down.
All right, Mr. Roy, thank you so much for joining us, giving us that perspective. We'll let you go.
Thank you so much.
All right.